Okay then, turning to an example, we have an investor that paid $300,000 for a 30% share. This is above the 20% presumptive test, and given we have no other information, and given that we know we're doing an associate accounting example, we're going to assume that that gives them significant influence but not control. The investor uses the cost method, and that becomes important because we know then that what's in the investor's books has not been adjusted to fair value, and that means we can use that as a basis for the adjustments that we make for profit and for dividends and for the other equity items. The investor is a parent, which means all of these adjusting entries will happen in the consolidated financial statements. They won't happen in the investor's own financial statements. And we have a standard tax rate of 30%. Turning now to the associate, so I'll just get rid of that. Turning now to the associate, the net profit before tax was $100,000. Obviously tax hasn't been taken into account there, which we will need to deal with. The change in retained earnings from the point in time where this company became an associate of the investor to the start of this financial year that we're dealing with is $80,000. There has also been a total change in the revaluation surplus from, I suppose if you can call it the acquisition time to now, of $70,000. There was a prior year transfer to the general reserve. So importantly, this was not a current year transfer. This transfer to the general reserve happened in a previous year. Could have been last year, it could have been a number of years before that. And lastly, there are current year dividends of $30,000. Now, all of these amounts are actually the full amounts for the associate. These are not a 30% share of the associate's amounts. These are 100%. This is actually what happened within the associate.